Let me start with a story. Meet Harish. He's 28 years, works in an IT company in Pune, and over 2 years of disciplined saving, he built a corpus of 3 lakh rupees. This was money meant for a family trip his parents had always dreamed of. One day, a friend showed him his phone and said, I put 50,000 few days back and it has already become 2 lakhs. This is options trading. Bahut easy hai. Harish went home and opened YouTube. Everywhere he looked, he saw reels, Telegram channels, and screenshots of huge profits. It looked like everyone was making easy money in futures and options. So Harish tried it. He started buying options on his phone, following tips from social media and Telegram groups. And within 3 months, his entire 3 lakhs was gone. Not some of it, all of it. The family trip, 2 years of saving, everything wiped out. Harish was not foolish. He was a smart, hard-working person. So what went wrong? He entered a high-risk game without understanding the rules. And this is what this video is about, to explain futures and options in the simplest possible way so that before you put your money on the line, you know what it is, where the risk lies, and why so many people lose money in it. And stay till the end because I'm going to show you one number from SEBI's own study that should scare every new trader before they place their first trade. Before we go further, let's clear one big confusion. Many people think they are investing when they do F&Os. In most cases, they are not. Investing means putting money into a good mutual fund or a stock and giving it time to grow over years. It is slow, boring, and that is why it works. It is like planting a tree and waiting patiently for the fruit. Futures and options are different. You're not buying something to own for long term. You're taking a short-term view on price movement, whether Nifty, Bank Nifty, or stock will go up, go down, or stay in range. That does not make F&O bad. It is a legitimate tool, and institutions and experienced traders use it for hedging and risk management. The problem starts when retail investors treat it like quick money without understanding leverage, expiry, premium, margin, and risk. An option is a contract that gives you the right, but not the obligation, to buy or sell something at a fixed price before expiry. There are two basic types. A call option, which is used when you think the market may go up. A put option, which is used when you think the market may go down. Let's take a simple example. Suppose Nifty is at 24,000. Harish thinks Nifty will go up, so he buys 24,000 call option. Let's assume the premium he paid to buy this option is 100 and the lot size is 75. So his total cost is 7,500. This is the premium he pays. Now here is the first thing every option buyer must know. The break-even point. Harish paid 100 points as premium. So his break-even is 24,000 plus 100, which is 24,100. Below 24,100, even if Harish is right about the direction of the market, he still loses money. Now let's see what can happen. If Nifty rises to 24,300 at expiry, the option has 300 points of value. Harish paid 100 points as premium, so his profit is 300 minus 100, which is 200 points. So 200 multiplied by 75 lot size is 15,000 rupees profit. So in this case, Harish paid 7,500 and made a profit of 15,000. Sounds exciting, right? But now let's see the other side. If Nifty stays at 24,000 or rises to only 2420 or is falling below 24,000, the option may expire worthless or lose most of its value. In that case, Harish can lose the full premium, rupees 7,500. So the buyer's maximum loss is limited to the premium paid. But the important point is this. Harish does not need Nifty to go up. He needs Nifty to go up enough and before expiry. That is where many beginners go wrong. They think I was right, Nifty went up, but the option still loses money because the move was too small, too late, or the premium was too expensive. In the options, direction alone is not enough. Timing and the size of move also matter. Let's understand futures. A futures contract is an agreement to buy or sell an asset like Nifty or a stock at a fixed price on a future date. Unlike options, futures do not have premium limited loss. In futures, profit and loss move almost point to point with the market. An example, suppose Nifty futures are at 24,000 and the lot size is 75. The total contract value is 18 lakh rupees. Now Harish does not have to pay full 18 lakhs to trade this futures contract. He pays only margin. Let's assume the margin required is around 12% for illustration purposes. So 12% of 18 lakhs is 2.16 lakhs. So with 2.16 lakhs margin, Harish controls a contract of 18 lakh rupees. This is called leverage. And now let's see what happens. If Nifty futures rise from 24,000 to 24,200, that's a 200-point gain and a profit of rupees 15,000. Nifty has just moved up by 1%, but on Harish's margin of 2,16,000, a profit of 15,000 rupees, which is almost 7%. So a small percentage move in Nifty has created a much bigger impact on Harish's capital. Now see the loss side. If Nifty falls from 24,000 to 23,800, that is a 200-point loss and a total loss of 15,000 rupees. Again, a less than 1% fall has given a 15,000 hit. Just imagine Nifty falls 500 points, which is around 2% fall. The loss could be 37,500. That is around 17% of the entire margin capital. And if losses increase further, Harish may get a margin call. That means he has to bring in more money immediately, or the broker may square off his position. Remember at the start of this video, I promised you one number. This is it. SEBI, whose job is to protect investors, studied lakhs of regular investors trading in F&O, and what they found was shocking. Roughly 9 out of 10 retail F&O traders lose money. Now let me put that number in perspective. Picture 10 of your friends sitting down to trade options on Monday morning, all confident, all hopeful. By Friday, 9 of them have lost money. Just one walks away with profit. Now be honest with yourself. What makes you so sure you would be that one? That is the reality of F&O for regular people. First, the odds are stacked against the buyer. If the market goes up just a little, you lose. If the market stays flat, you lose. If the market goes down, you lose. The market has to go up by a lot and quickly for you to win. Second, time works against option buyers. An option has an expiry date. Every day that passes, the option loses some value. This is called time decay or theta. Think of it like an ice cube melting quietly. Even if the market does nothing, the option can keep losing value as expiry comes closer. Third, leverage and position size can destroy capital. In futures, one contract can control lakhs of rupees of exposure. In options too, people buy multiple lots because the premium looks small. But small premiums across many lots can become a big loss. Fourth, tips create false confidence. Telegram groups, short calls, and screenshot of profits can be very misleading. Someone may give 10 tips. 2 work, 8 may fail, but only the 2 winning screenshots are shown. Fifth, and one of the most important ones, you are often trading against a stronger player. Harish buys an option and someone else is selling it to him. That seller may be a more experienced trader or institution with better systems, deeper pockets, and stronger risk control. Think of the option buyer like someone buying short-term insurance, hoping a big event happens before expiry. And the option seller is like the insurance company collecting premiums again and again, knowing that in many cases, nothing dramatic may happen before expiry. Now, before you think, then let me just sell options instead. Wait, option selling is not a shortcut either. Sellers face potentially unlimited losses, need large capital, and need strict risk control. One bad day can wipe out months of profits. That does not mean option buyers or sellers can never make money. They can, but it means the game is much harder than it looks. Sixth, costs eat into your profits. Brokerage, STT, exchange charges, each trade has costs. Trade frequently and they pile up. SEBI found many traders were profitable on paper, but in loss after cost. You may ask, but some people do make money in F&Os. How? Yes, they do. But for them, it is not gambling. It is a serious skill built over years of learning, discipline, and risk control. If someone wants to approach F&O sensibly, these are the 3 things they must understand. First, know what is an option chain. The option chain is like a market dashboard. It shows where traders are active, which strike prices have high open interest, and where support and resistance may lie. But remember, the option chain is a guide, not a guarantee. Second, understand what moves option prices. Option prices move because of market direction or time passing or volatility. This is where concepts like delta, theta, vega, and gamma come in. They are very important and you should understand them properly before jumping into options. Third, control risk before chasing profit. Do not put too much capital in one trade. The goal is not to become rich in one trade. The goal is to make sure one bad trade does not destroy your capital. Many disciplined traders dealing in options use defined risk strategies like spreads, where the maximum profit and maximum loss are generally known before entering. Some of the popular spread strategies are bull call spread, bear put spread, bull put spread, and bear call spread. Start with learning these first, and once you become proficient, go on and learn other popular strategies to get better at options trading. Before any F&O trade, ask yourself 4 questions. First, what is my market view? Am I bullish, bearish, or neutral? Second, does my trade structure match that view? Third, what's my maximum loss? Ideally, one trade should not risk more than 2 to 3% of capital. Fourth, what's my exit plan? At what loss will I exit? At what profit will I book? And what will I do if the markets move sideways? If you cannot answer these questions clearly, do not place the trade. Because in F&O, the real skill is not just finding an opportunity. The real skill is controlling the downside before chasing the upside. Let me end with Harish. After his losses, he told me one simple line. I thought I was investing. I later realized I was taking leverage bets into something I didn't fully understand. And that's the real problem with F&O for many retail investors. Not that it is bad, not that the market is unfair, but that people enter it without understanding the leverage, the risk, and the discipline it demands. F&O is a legitimate financial tool. Used properly, it can help in hedging and managing risk. But if it is used as a shortcut to make quick money, it can damage capital very quickly. If this video has helped you, share it with someone who's just starting out in the markets. It may save them from a very expensive mistake. My name is Kishan Jakhotia, and I will see you in the next one.